There's no chance that we can predict the future. We're not trying to predict the future. But what we can do is be informed around what today looks like, what yesterday looked like, and see if we can't find any sort of relationship between yesterday and today and make some assumptions on the predictability of tomorrow. Welcome to a new podcast where we'll be breaking down the world of investing. My name is Thomas O'Keefe.
And I'm Phil Neuhart. So today what we really want to do is dig in a little bit deeper on investment topics. This is something we plan to do going forward, really in podcast form. A lot of our listeners and viewers are used to kind of short, pithy videos. And what we want to do here is take a moment to dig in deeper on topics, particularly in the investing world.
Yeah, we're gonna take deeper dives into topics that we think are interesting to our audience. And we also want to focus on the narratives. Investing uses a lot of data, a lot of numbers. It can get really complicated, but at the end of the day, we need to know how we can make decisions based off of that. So we're going to really explore the storytelling and the data behind all of those numbers.
That's right. And it's hard to start a series like this without starting with how we invest money. So something we want to do today is take some time to dig into our investment principles.
Yeah, and so we have 8 core guiding principles. Now, what's the magic behind 8? There is no magic. But really, when we think about how we invest money for our clients and what we need to focus on, there were 8 that really stood out to us.
Yeah. So what's the big overarching principle that we follow?
Yeah, I think really at the top level of all of this is we want to look forward, not backward. And that may sound intuitive to most, but a lot of times in investing, we're looking at historical data and we're oftentimes framing the decisions we're making based off of the past. Now, I'm not saying we're not doing that. We do that as well. But what we're trying to do is take that information, take that data that we have, and try to inform ourselves on what the future might look like. We can't predict the future, right? And there's no chance that we can predict the future. We're not trying to predict the future. But what we can do is be informed around what today looks like, what yesterday looked like, and see if we can't find any sort of relationship between yesterday and today and make some assumptions on the predictability of tomorrow.
You hear this term, capital market assumptions. Well, what is that, and how does that feed into our process?
Yeah, that's really the starting point of all of this. And this is where we're ingesting most of our information, most of our data. These capital market assumptions, you'll often hear CMAs as a short form for it. This is the return assumptions that we have that we put into our entire process. And so when we go back to look forward, not back, these numbers that we are producing are based off of all of these inputs that we have, current inputs, historical inputs, our understanding of the past, our understanding of the current, and then we're hoping that we can find some predictive value that will drive us to better decision-making on what will happen in the future.
We aren't using history as a direct analog, but history, the future can certainly rhyme with the historical. Is that the idea?
Yeah, let's give an example, and this is near and dear to you, is interest rate policy, right? So we can just look at the past or even the current and make assumptions based off of the past and the current on where interest rates currently are and just use that as a baseline. But we all know based off of many different factors, and you can comment on this better than I can, but many factors lead us to believe that interest rate policy might go in a certain direction in the future. And so we want to be positioned properly based off of where we think it's going rather than where it was in the past.
Yeah, it makes sense. And when you start thinking about specific asset classes, there's so many, these CMAs, these capital market assumptions, there's so many inputs that can drive international small cap. For example, and we start to think about currencies. There's just so much. So is our process a regression-based process in terms of our models?
Yeah, so we use different regression models. Once we've acquired all the data, we put them into our own proprietary regression models that we've built in-house. And those models are really leading us to our understanding of the sensitivity or the relationship, I should put it, between different data points and the potential return that we're going to have into the future.
And by the way, I think in the future, we will probably dig into some of these core tenets in much more detail than today.
We could spend a whole day on this.
Exactly, on that one. But what? Let's move on and talk some other tenets that really matter to our process.
Yeah, actually, number 2 and number 3, I'll talk about them individually, but both of them are really focused on wanting to stay long-term. The next one on our list is really outcomes are more predictable over time. And so what does that mean? If you asked me right now what the S&P 500 return will be tomorrow, I'd have a hard time telling you. Now, maybe I could make some assumptions and say, well, there's some economic data is coming out tomorrow, or some earnings for certain companies are coming out. So I might be able to make an educated guess. But at the end of the day, it's very challenging to know on a day-to-day basis what returns you're going to expect. But if you asked me, what do you think the return of the S&P 500 is going to be year over year for 30 years, I could probably give you a pretty good sense of what that might look like, barring any massive catastrophes there. We want to be long-term in nature in how we think about it.
Even when we're thinking about the stock market, our S&P 500 price target, there's a reason we have a 12-month price target and not year-end.
Yeah.
The issue with year-end price targets is here we are in August. You're basically seeing where is the S&P in 4 months, right? We'd much rather directionally have a sense. So even in the world of market and economic research, we think about these things a little bit more medium and long term. But it is also a reminder for a client to have a plan and have the correct buckets of assets, because yes, over a 30-year period, we might have a decent sense of what U.S. stocks are going to do, but that could look very different over the next 1, 2, 3 years. So if you aren't structured correctly in a portfolio, that can really drive some issues.
Yeah, and these actually lead into some of the other principles that we have. They're all very related to each other, which is so convenient. But I would say the other thing, and speaking of related to other principles that we're going to talk about later, think about the risk. If, say, the pandemic hit again tomorrow, just randomly, there's another pandemic, it happens tomorrow. We couldn't have predicted that, and our one-day returns would be awful. Our 1-week returns would probably be awful. Our 1-year returns might be awful. But you throw a pandemic in a 20-year period, and it smooths out. That risk becomes, I don't want to say less important. Obviously, the risk mattered, but in terms of the actual returns you're going to get and the cyclicality of the returns over time, it becomes less important.
Think about this year. We had a 19% drawdown on the S&P 500, and here we are up high single digits.
That's right.
As of today. It's as if that drawdown didn't even happen. It's amazing how quickly these things can smooth out over time.
Yeah, and so just putting some numbers to this, we looked back at the S&P 500 back to 1999. Rolling 1 year, the max was 55%. So there was one rolling year period where you earned 55%. There was one rolling year period where you lost 43%. So if you look at a 1 year period, there's a lot of variance, right? So again, investing for even a 1 year period, we were talking about 1 days, but 1 year period, tons of volatility and very hard to predict. Now, you go out 20 years, the max return was 10% and the min return was 4%. So it's not even negative over rolling 20-year periods.
Which for most folks, equities are a very long-term asset class. So really, we are so focused on the news of the day and the impact and what was the next 1 month return. But the truth is, for most, it's actually multi-decade that matters. How does this all feed into compounding?
Really, compounding is just another variable in our desire to be long-term, which is why 2 and 3 are so related to each other. If you think about compounding, what compounding is it's returns on returns. Let's say you have $1 million of cash that you invest today. Your principal is $1 million. Let's say you earn 7% a year on that $1 million. So at the end of the year, your balance will be $1,070,000, right? Because you earn, and let's assume no transaction costs or taxes. So now you in your account, you have $1,070,000. So you've got a principal of $1 million, you've got a return of $70,000, you have 0 on compounding. Now in year 2, what do you start with? You start with $1,070,000. Now again, you're going to earn, let's assume 7% return, you're going to earn $70,000 on your 1 million principal. But what do you also earn? You earn a return, that 7%, on the $70,000 that you earned in year 1. So here's the most fascinating thing. That compounding matters. And if you look at, we did this for the S&P 500 over 30 years, and you could change the years, you could change the rate of return, you could change how much you invest. None of that really matters. The same principle is the same. But over 30 years, S&P 500 earning 7%, 60% of the value after 30 years was compounded returns.
Absolutely.
That's incredible.
It really is one of the wonders of the world.
It really is. And so what does that make us focus on? It makes us focus on staying invested in the market. If our audience takes nothing away from this, it is stay invested in the market, because the more that you can compound, the better your returns are going to be. You want that compounding to be as big a percentage as possible.
Yeah, you can really impair your assets by trying to time the market. So for taxable clients, how do taxes fit into our investment principles?
Yeah, so we should think about taxes as a drag. It's just going to be a drag on returns. And so we work with clients that are both taxable and tax exempt and tax deferred. If you're tax exempt, this conversation likely is not that applicable. There are other reasons or ways that we can optimize. Let's really focus on a taxable client. Taxes are purely a drag, and that's how we look at it. So you should expect whatever your pre-tax return is, you're going to have taxes on it. They're going to be lower. It's going to be lower. And so when we make decisions here, we always need to think about the impact of those taxes. We want to minimize the amount of that tax drag. And so that could be through various strategies. It could be through things like tax loss harvesting. It could be through investing in municipal bonds. There's many different ways that we can think about it, but turnover is another way that we think about it. Lots of turnover generates lots of taxes. And so we just want to make sure that in every decision we're making for our taxable clients, that we are looking at after-tax returns, the impact of that drag, because some investments will no longer be good investments if you have to look at the tax impact.
And it really highlights the importance of planning, right?
100%.
There's so many strategies on the tax front that you and I are certainly not experts on, but our financial planners spend a lot of time thinking about these various strategies.
That upfront planning can do so much to save our clients tax burden. And so it doesn't only have to be at an investment level, it can be at a planning level.
Right.
And sometimes the biggest gains or advantages that you're going to get are not in your ability to get an 8% versus a 7% return. It's your ability to not pay as much in taxes.
How does risk come into our framework? How do we think about managing risk? Obviously, just as important as return in a lot of ways.
Moving down the core principles is our ability to manage risk. We can manage risk at two levels, at an enterprise level and at a client level. The client level is kind of what we were talking about with taxes. Every client is going to have a different ability and willingness to take on risk. And so we just want to make sure at the beginning planning stages that we are setting up the right legal structures, we're setting up the right risk tolerances, we're setting up the right plans in place for the right time periods. Those things matter at a client level. Then at an enterprise level, and so this is more a situation where our teams are working on understanding the key valuation metrics that we're using to be able to identify what risk is. So first you have to identify risk, right? There's tons of risk metrics out there. The most common is standard deviation or volatility. And so we're going to use that a lot in how we think about optimizing portfolios. So that's a quantitative risk, right? You could also look at drawdown risk. You could also look at different quantitative metrics that we can use to identify what are the risks we want to take and don't want to take. Because risk isn't just bad.
Well, and look, we want to maximize return per unit of risk, right? So you just want to make sure you're compensated for the risk you are taking, because a principle that's always going to hold in the world of financial markets is risk and return moving together, right? You're compensated more for higher risk, but we want to understand how risky is the investment and what is that compensation. And sometimes, yes, there's compensation, but the risk is so high that it's not worth the juice is not worth the squeeze. Essentially,
that is 100% right. Risk is okay as long as we know it, we understand it, and we're being compensated for it. And then it ties back into what the client actually wants, right? If a client doesn't want that level of risk, then that's fine. We move into a strategy that has lower risk. And like you said, It has consummate returns that will be lower as well. There is also qualitative risks that we assess as well. Great example of this is key person risk, right? When we're doing due diligence on a manager, we look at the risk inherent in a business. Somebody gets hit by the proverbial bus, or retires, right? If that situation leads to us having less conviction in a particular strategy or a particular manager, then that is a very clear qualitative risk that we need to measure.
So you kind of open the door. Let's talk about how we pick managers. Speaking of a topic we could spend an entire podcast on, so we don't have to go too deep, but tell us a little bit about our philosophy around picking managers, knowing that the majority of return is explained by asset allocation decisions, the big decisions. But certainly underneath the hood, you want to have good managers, and you want to have managers where they can generate excess return versus more efficient asset classes.
We really want, and this is sort of our sixth core principle here, is we want managers who are able to have a competitive advantage and repeat that competitive advantage over multiple time periods.
And you really can't emphasize that enough, right? Well, let's say a manager has a wonderful year. You invest in that manager. If it's not a repeatable process, you're just paying for past return. You're not paying for future return. It being repetitive and understanding what drove that excess return is so important, isn't it?
Yeah, and if you look at what's happened over the past 2-3 decades, even longer than that, is this expansion of ETF index investing. So what has happened? There's been a complete lowering of fees, a truncating of fees across the board to be able to access just the markets broadly. A lot of this is markets are incredibly efficient. Again, it depends. This could be a whole nother session on which markets are efficient and where we think that there's value.
And there's a lot of debate.
Yeah, certainly. But generally, equity markets have become more efficient. The information advantage that folks have has decreased. There is a higher threshold for folks who are charging fees for active management. So if we are going to, I mean, this is back to, you better be compensated for your risk. You better be compensated also for the fees that you're paying. So if we're going to pay a manager some sort of fees above and beyond what an index fund would charge, we expect them to be able to have some sort of competitive advantage, and we expect them to be able to deliver that over time. Basically meaning that you can't arbitrage out their competitive advantage.
Right. Okay, so we've touched on a lot of topics here. I know our last couple core tenets kind of speak to how do we move forward with everything we've discussed. So how do we think about changing environment and things that happen in the world? I mean, how do we think about taking those tenets we've covered and applying them in a real world go forward basis?
They are the last two. I don't want anybody to think they're the least important. Honestly, they might be the most important because everything before this conversation relies on these last two being solid and strong and adhered to by the team.
Right.
The second to last principle we have is really be consistent, be repeatable, and make sure everything you do is testable. This matters because if we look at where most folks lose the most money in an investment process, it's when emotions take over and you abandon your conviction because something hard is going on. That's a recession. It could be a pandemic. It could be anything where you make decisions not based off of what is prudent.
This February or April, I should say, timeframe is a great example, right? We had a severe drawdown, and then we had a delay in tariff implementation, and in one day, the U.S. stock market rallied 9.5%.
That's right.
In one day. If you miss that, that's a year of return. So you don't have to look that far into the past to understand why it's easy to say, but hard to do sometimes to stick to the plan, right?
Investing is emotional.
Exactly.
Right? It's very emotional. And so we want to take as much of that emotion out of it on a daily basis. Headlines, looking at specific returns, whether they're good or bad, they can trigger certain reactions from us. Right. Now, what we want to do is we want to look at those. We want to ingest and digest all of that information. But at no point do we want to make reactionary decisions just because something is going on that either we don't understand or scares us.
Right. And for folks that have invested for a long time, something you learn is just the vast majority of these headlines, news flow, et cetera, is just noise.
That's right.
The vast majority. I mean, in the end, it's about fundamentals, and that's what the market gets back to. The market can be irrational for a short period of time, but eventually gets back to the facts. So in that context, you mentioned sort of the first of the last two tenets. Well, what is the final tenet?
The last one is that we need to constantly be adapting. That means that we need to be in a constant state of challenging the status quo, challenging ourselves, challenging the principles we just talked about based off of an ever-evolving economy, a market, geopolitical situations. We need to understand how our models work, how different data that we're putting into them might change the way we think about that model. So as much as we want to stay true and disciplined to what we believe in and not be reactionary to market movements, we also want to make sure that where we see opportunities to be better, that we are taking those. And so the team is constantly looking at where can we make changes to the process that are not cyclical in nature. We're not trying to follow something, but we're structurally trying to make ourselves better, smarter, more efficient, therefore creating better outcomes with the decisions we can make.
Right. It's constant improvement.
That's right.
Right. To set a process and say, well, we're never changing this.
Yeah.
That doesn't really work in the real world. In the real world, we need to get better, right? Technology changes, tools change. And so we have a whole staff that really is every day thinking about how do we improve our process? How do we make it better for our clients?
Yeah, it's great. I mean, easy examples of this. There's been a lot of new product creation over the last 10, 20, 30 years. If we would have just said, no, we don't invest in those things, we would have been left in the dust. One that definitely deserves a whole nother conversation between you and I is how AI can now potentially be utilized in all of this. We can't just sit on our hands and say, sure, this is, passing in the wind and we don't need to think about it. Now, how we implement it needs to be really thoughtful, but certainly a place where we're an example of where we need to be thoughtful and diligent and have a good understanding of how the future might change the way that we allocate capital for our clients.
Absolutely.
And that basically, Phil, is our high-level 8 guiding core principles. And I hope this was interesting to everyone. I hope that not only this, but hopefully future topics that we have, which are going to continue to take deeper dives into the world of investing, how we think about things here at First Citizens Wealth, and how we think about investing capital for our clients. I can't wait for us to get back in this room again and do it again.
I agree completely. Thank you, everyone, for listening.
Are solely those of the authors and do not necessarily reflect the views of First Citizens Bank and Trust Company or any of its affiliates. This material is for informational purposes only and is not intended to be an offer, recommendation, or solicitation to purchase or sell a specific investment strategy, any security or insurance product, and should not be construed as legal, tax, or accounting advice. Please consult with your legal or tax advisor regarding the particular facts and circumstances of your situation prior to making any financial decision. While we believe that the information presented is from reliable sources, we do not represent, warrant, or guarantee that it is accurate or complete. Many companies referenced in this content are independent third parties and are not affiliated with First Citizens Bank and Trust Company. All third-party trademarks, including logos, trade names, service marks, and icons referenced remain the property of their respective owners. Your investments in securities and insurance products and services are not insured by the FDIC or any other federal government agency and may lose value. They are not deposits or other obligations of or guaranteed by any bank or bank affiliate and are subject to investment risks, including possible loss of the principal amounts invested. Past performance is no guarantee of future results. Estimates of future performance are based on assumptions that may not be realized. This material is not a solicitation of any offer to buy or sell any security or other financial instrument or to participate in any trading strategy. Diversification does not guarantee a profit or protect against loss in a declining financial market. First Citizens Wealth, FCW, is a marketing brand of First Citizens Bancshares Incorporated, a bank holding company. The following affiliates of First Citizens Bancshares are the entities through which FCW products are offered. Brokerage products and services are offered through First Citizens Investor Services Incorporated, FCIS, a registered broker-dealer, member FINRA and SIPC. Advisory services are offered through FCIS, First Citizens Asset Management Incorporated, and SBB Wealth LLC, all SEC registered investment advisors. Certain brokerage and advisory products and services may not be available from all investment professionals in all jurisdictions or to all investors. Insurance products and insurance are offered through FCIS, a licensed insurance agency. Banking, lending, trust products and services, and certain insurance products and services are offered by First Citizens Bank and Trust Company, member FDIC, and an equal housing lender, and SBB, a division of First Citizens Bank and Trust Company. For more information about FCIS, FCAM, or SVBW and its investment professionals, visit www.firstcitizens.com/wealth/disclosures.